What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're going to talk about a topic that it's pretty critical for real estate investors using partnerships. So we're going back and talking some more about this partnership setup because it's a very common setup for investing in real estate. So the multi-member LLCs, which follows a partnership. So today's topic, we're going to talk about something called a Section 754 election. So this little piece of the tax code can save you or your investors thousands of dollars of what otherwise would be missed depreciation. And some deals, it could even be a deal breaker if it's not being handled right. So let's get into it, talk about what it is. So what the heck is a Section 754 election? So we'll start with the basics. Section 754 election is a special election a partnership can make. So the partnership itself actually makes the election to adjust the basis of its assets when certain things happen, like when a new partner buys in or if a partner exits or dies. Here's a common scenario. Let's say your partnership owns real estate of multifamily property. Over time, you've been depreciating the asset, so the tax basis has dropped. Meanwhile, the fair market value of that property has gone up, hopefully. So let's say a new partner wants to buy into the partnership. So they're paying a premium because the property has appreciated, but from a tax perspective, they're walking into a partnership with a lower adjusted basis that was based on that original purchase price minus any depreciation. So it could be a raw deal for this partner buying in unless you make a 754 election. So what that does is it allows the partnership to step up the basis of the underlying assets just for that incoming partner. Now they can depreciate their portion of the property based on what they actually paid to get in. So they're not getting shortchanged on the depreciation. So this it kind of helps equalize things a bit, if you will. So there's two situations where this 754 election comes into play. So they're little subsets of 754. So there you have what's called a 743B adjustment. So this is the one you'll typically see most often. Real estate, it applies when a partner sells their interest or passes away and someone else steps into their shoes. So someone buys their interest, or if they pass it away, someone inherits it. So the election adjusts the inside basis for this new incoming partner only. There's also a 734B adjustment. So this kicks in when the partnership itself buys out a partner. So it's less common, but it's still an important exit strategy to understand. Say you have four partners in a multi-member LLC that owns a piece of real estate. One wants out for whatever reason. They decide to have the partnership buy them out. And that's where the 734B adjustment comes into play. In either case, the goal is to match the economic reality, what someone actually paid, with the tax reality. So what they're allowed to depreciate or deduct. So, we'll often hear, a lot of people ask, when should you make the election? That's a great question. It actually came up in a recent tax planning session. So you want to consider a 754 election anytime you're bringing in a new partner or a partner's exiting. So if a partner dies or is leaving, someone's buying their interest, that's your cue to kind of talk to your tax professional about this. In fact, some investors, especially private equity firms, they may require it. They want the basis step up. They want the depreciation. And their operating agreement may be structured in a way that says you have to make the 754 election. So you want to make sure your operating agreement gives the manager authority to make the 754 election when possible. You don't always necessarily just want to make it because it could get a little hairy, especially if you have several older partners that are retiring or dying. Really, you want to make sure you have that flexibility in the operating agreement. You don't want to scramble to amend documents at the last minute. Now, one catch is once you make the election, you're stuck. So that's sort of a big but. Once you make the Section 754 election, you're locked in forever for the life of the partnership. So that means every time you have a similar transaction, new partner buying in, someone selling or dying somehow, otherwise going out, you have to do another basis adjustment, which sounds fine at first, but let's say you have 10 investors in their late 70s, one passes away every other year, and you've got 754 election every other year. So now you're stuck doing these, annual or every other year fair market valuations of the partnership assets. It's a lot of time, costs, and complexity that grows with your investor base. So you want to make the election when it's worth it, and when the dollar amount is significant enough to justify the administrative burden. Someone had asked before, when you do step downs ever happen? It's possible, but it's rare. So if the asset value declines and you've made the 754 election, then you don't just get the benefit of step ups. You're required to do a step down in basis if the fair market value has declined. That's not fun. However, I've actually never had to deal with one of those, and they're pretty rare. Over time, real estate does tend to appreciate. So the whole point of the 754 election, maybe just talk through a brief example, is let's say you had two partners that buy $1 million property and they each own 50%. They each brought $500,000 to the table. And let's say 10 years later, this $1 million property is now worth $2 million, but they've taken $500,000 in depreciation. Now, one partner wants out. They sell their 50% interest to someone else. Well, that person's coming in, they're buying an asset that's now valued at $2 million. So their 50% share is $1 million. However, the adjusted basis of that property is only $500,000 in the partnership. So a 754 election would equalize things. So this incoming partner, they're paying $1 million. Now their depreciation deductions are based on an asset that's valued at $1 million, or their 50% share of a $2 million property. They're not stuck with the $500,000 of adjusted tax basis that where things are in the partnership. So that's the whole point of the 754 election. If you're bringing in new investors, especially at a premium, good time to consider a Section 754 election. Remember, you want to have the authority in the operating agreement that gives the manager the discretion to make it. And just be aware there are trade-offs. So once you make the election, it is final. So just some things to be aware of, and always make sure you're discussing with your tax pro. If you're considering something like this is not a do-it-yourself type of situation. But that about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. Are you interested in becoming a client? Click the Discovery Meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.